Okay. So we have another few seconds. I think there's still some people milling in. Okay then, guys. Well, thank you very much for attending, everybody. This is our webinar on UK tax residency and the impact of COVID-19. I'm just going to run through a few general bits before we begin. The webinar today is going to be presented by myself and my colleague Lewis Trevelyan.
Morning, everyone.
Who is one of our tax consultants and someone that deals quite a lot with residents at our firm. And he'll also be having a section on the statutory residence test and some finer points of residence, and he'll be taking you through that shortly. A little bit about our firm. I mean, our vision is that we're trying to enrich lives by making tax simple, breaking tax down into ways that clients and advisors can understand. We're a service-based firm. We don't have any tax products. We assist people by interpreting tax legislation in the right way. And the main aim of what we're trying to do is ensure that clients are paying the right amount of tax, but not necessarily any more than they need to. So we consider all relevant reliefs and allowances that should be available. What do we do? Well, we do tax advice that can come in many number of things, including for businesses, sort of share, company share option schemes, demergers, family investment companies, and then also with a focus on personal tax, things like inheritance tax planning, and residents like we're going to come through today. We also offer a tax director service for accountancy firms where we can operate as an in-house tax department for your clients. We assist with tax returns, share valuations, and tax investigations and voluntary disclosures, to name just a few things that we do. A little bit of general housekeeping. And it aims to finish for 10 AM sharp. All your microphones will be disabled throughout, but you will have the opportunity, if you'd like, to lob some questions in our Q&A box as the webinar proceeds. And Lewis, if we have time at the end, Lewis will ask those. If we don't get a chance to answer your question, we will aim to follow up with you after the discussion and perhaps email you and have a chat about your queries. There should be a short breakout session at the end, though, if you do want to stick around and have a chat with myself and Lewis. And then just a final point, this presentation is just for general information, so it's not intended to constitute actual advice. So it is recommended that if you have a tax issue, that you seek the advice of a competent professional. So I'm just going to hand over now to my colleague Lewis, who's going to take you through how the statutory residence rules work and a little bit of background on tax residence. So hand over to you, Lewis.
Thanks a lot, Ryan, and morning, everyone. I hope you're all well. I suppose you don't have a lot of time this morning, so let's get right into it. So firstly, I'll be starting off with why your resident status is important and why we're doing this webinar this morning. This is because whether someone is considered to be UK tax resident will dictate their liability to UK tax. The general rules are that UK residents normally pay UK tax on all of their income, whether it's from the UK or abroad. But there are special rules for UK residents whose domicile is abroad, where we'll discuss more about what domicile is later. On the other hand, broadly speaking, non-UK residents will only be subject to UK income tax on their UK source income, such as income from UK property and dividends from UK companies. And foreign income will only be taxed in the country it was earned. I change slides.
There you go.
So now on to the statutory residence test. The statutory residence test is a set of tests written into UK tax law that determines the UK tax residence status of individuals who have some degree of presence in the UK, whether they are living in the UK or not. However, the complexity of it should not be underestimated. Fundamentally, there are three main components to consider as part of the statutory residence test, which are required to be applied in the following chronological order. The first test to consider are the automatic overseas tests, where any one of these tests are met, you will be automatically non-UK resident for the whole tax year. If you do not satisfy any of the automatic overseas tests, the next step is to consider the automatic UK tests, where if you satisfy any of these tests, you will be deemed as UK resident for the tax year. If none of these above automatic tests are met, the sufficient ties test is then considered. For each of these tests, the amount of days an individual spends in the UK is significant, where the general rule is that any day you're in the UK at midnight, that's counted as a day spent in the UK. So we don't have time this morning to run through the different steps of the automatic tests. However, the diagram on this slide highlights each of these steps, and we are currently preparing a residence guide that we can send around and circulate to anyone who is interested in learning more about how to apply each of these tests. In relation to the sufficient ties tests, the number of ties required for UK tax residents will depend upon the number of days you have spent in the UK in the tax year and whether you are an arriver in the UK or a leaver. The tables on this slide shows how a number of days you spend in the UK interact with your amount of UK ties in order to determine whether you are deemed to be UK resident, where the more days spent in the UK, the fewer ties you need in order to be considered UK resident. The four main ties to consider are the family tie, the accommodation tie, the work tie, and the 90-day tie. There is also a fifth tie to consider where you have been UK resident at least one out of the 3 previous tax years, where this is a country tie, which is satisfied when you have spent more days in the UK in the current tax year than any other country. Where you do not have sufficient ties to be a UK tax resident, as per the tables on this slide, you will be considered as non-UK tax resident for the tax year. So now on to split year treatment. Split year treatment may apply where you have clients entering or leaving the UK during a tax year. If you are a UK resident for a specific year and have departed from the UK or arrived in the UK at some point during this year, then it is possible to split the tax year into a period of UK tax residence and a period of non-UK tax resident, subject to meeting the conditions of at least one of the 8 split year cases. Each of these cases have detailed conditions and are fairly complicated on how to qualify split year treatment and when the relevant periods start for residents and non-residents during the tax year. So yeah, there are 8 broad sets of circumstances which may apply to you in the year that you arrive or depart from the UK. In each of these circumstances, there are other conditions you must meet. However, each of these circumstances include leaving or entering the UK for new full-time work or ceasing or establishing to have a home in the UK. So you may also have clients who are resident in the UK but are domiciled in a different country. Domicile is a concept of common law in the UK, and each individual has only the one domicile. Many people are unsure as to what this concept actually means, where it's not the same as nationality, residence, or citizenship. Your domicile status is best defined as a country where your homeland is, whereby the country in which you have a permanent home and where you plan to live indefinitely are 2 of the predominant contributing factors in determining this. This slide shows that there are 4 different types of domicile, where guidance on the differences between these can be found in our domicile blog on the PD Tax website. So why is domicile important? An individual who is resident and domiciled in the UK will pay UK tax on the arising basis. This means that they will pay UK tax on their worldwide income and gains, regardless of whether they bring the income or gains to the UK. Whereas an individual who is resident but not domiciled in the UK may be able to choose the remittance base of taxation, subject to rules published by HMRC, where this will allow them to exclude their foreign income and gains from the scope of UK taxation. By using the remittance base of taxation, you pay UK tax on UK source income and gains, but only pay UK tax on foreign income and gains if they are remitted back to the UK. There may, however, be a cost to claiming the remittance base of taxation, including the loss of the use of the personal allowance, and you also won't be able to use the capital gains exemption. So I think that brings me to an end. So I hope you all found that interesting, hopefully somewhat useful. I will now be passing on to Ryan to take us through further important residence tax information.
Thank you very much, Lewis. That's brilliant. I'm just going to tack a few small points onto the end of Lewis's section there, just about residence itself. One of the main things we need to be considering when we're looking at UK tax residence is the double tax treaties. The double tax treaty is basically a contract that the UK will have, and it has many, with another country that basically, including the name, determines whether one or both countries has the right to tax a certain category of income or gains. And the main driving force behind the double tax treaty is to ensure that an individual is not unduly subject to tax in more than one area. So not subject to tax on the same income or gains in both countries. It also mentioned there in the third bullet point that it may well allow you to determine which country you are subject to tax in if you are subject to tax in both. There may be a tiebreaker clause in there that basically says that you would be, if you're tax resident in both the UK and another country, subject to meeting certain circumstances, you would be tax resident in only one of them and therefore only subject to tax on your income and gains in one of them. I think the UK has more double tax treaties with countries than any other country. But if the UK doesn't have a double tax treaty with a specific country, then you should still be able to get tax relief in the UK on any foreign tax that you've suffered on that same income. So it's not, even if there isn't a double tax treaty, it's not the end of the world, let's say. So just to kind of run through what we've covered so far, which has very much been a whistle-stop tour of residence because there's a lot of content there. But a UK tax resident is going to be subject to UK tax on their worldwide taxable income. Although if they are, we want to be considering the double tax treaty because that may provide some relief in relation to income and gains. It may provide that certain income and gains is taxable perhaps only in the foreign country. And that might help to reduce the UK tax bill. So it's important to consider those tax treaties when we've got foreign income. If we have a UK tax resident who is a non-UK domicile, then we want to be considering a remittance basis election if they have income and gains from overseas, because what that will allow us to do is possibly ensure that some of that income of gains is not taxed in the UK, provided that they keep it out of the UK and they don't remit it to the UK. They don't bring it in and spend it in the UK or otherwise bring it in other ways. As Lewis has mentioned, there can be a cost to that, and certainly after a period of time where you've been UK tax resident in the UK for many years, that you may well be deemed UK domicile, in which case we can't make that claim anymore. But it's something to consider if domicile is in question. And of course, non-UK tax residents should only be subject to UK tax on their UK income and gains, so things like UK property income, UK bank interest, things like that. So I'm going to run a quick poll now, which for those of you that do have clients will apply. For those of you that don't, it won't. But have you had any clients who were restricted from entering or leaving the UK due to COVID-19? I'll run it now. And yeah, we can have 30 seconds just to submit your answers. There we go. I think most people have answered now. So it looks like the majority of us are having clients that would have been affected by COVID-19, probably in the 2021 tax year. Yeah, it's interesting, and hopefully the next section of the webinar will be helpful to those advisors, because we're going to cover some of the areas where COVID-19 and the statutory residence test is going to interact. Okay, so how has COVID-19 affected the residence rules? Well, within the UK statutory residence rules that Lewis has covered a little earlier, there is under many of the provisions, there is an exception for exceptional circumstances. So situations where you might have been in the UK for longer than expected as a result of some unforeseen event. So the HMRC has provided some additional guidance there. And there's also some considerations that we need to look at around employment income, both for non-UK tax residents and for UK tax resident non-domiciles that have employment income. And then finally, we will cover off some bits that may not be as common for most of us, but for anyone that is assisting individuals that have come to the UK to work on certain coronavirus related activities, there may be some exceptions to the residence rules there. So moving on to the first one, the 60-day count. So of course, with coronavirus and everything that went on in the last tax year, there were a great deal of travel restrictions, and so what we might have expected to see is individuals who were stuck in the UK that may well have not expected to be here, or if it have stayed longer than they would have wanted to. And what HMRC has done is they've had a look at the kind of guidance around exceptional circumstances, and extended that to circumstances that they will accept have arisen out of COVID-19 when an individual may have not been able to move as freely as they otherwise would have wanted to. The point here that the 60-day count, the exceptional circumstances, it applies to a lot of the specific residence tests that Lewis covered earlier on, but it doesn't apply to all of them. So it's important to make sure that we're looking at the right sections here. But certainly what it does is it allows us to basically disregard certain days in the UK where you were present here because of exceptional circumstances. It's always going to depend on the particular facts of the situation, and typical examples include war, civil unrest, serious accidents and injuries that meant that you were in the UK for longer than you really intended to be. So it's quite a high bar to satisfy in order for a certain day to be considered exceptional. And as Lewis mentioned, a lot of these statutory residence tests do have some element of day counting within them, whether it's a day you were present in the UK, a day that you were working in the UK, a day that you were in home in the UK. There's quite a lot of day counting going on when applying the statutory residence rules. So these exceptional circumstances are going to be very much relevant for advisors preparing tax returns for the 2021 tax year, because I think many people would have been affected by COVID-19 and not expected to be. So the examples that HMRC have provided that they will consider as exceptional is where an individual is quarantined or advised by a health professional to self-isolate in the UK, or otherwise advised by government advice not to travel from the UK as a result of coronavirus. Individuals have been able to leave the UK because international borders were closed. That would be considered exceptional, and also individuals asked by their employer to stay temporarily in the UK as a result of the virus. Just to skip back there, this 60 days, it's a limit of 60 days. So if you have an individual that's perhaps required to stay in the UK for 70 days, we can only exempt up to 60 days within these rules. So any days over that will factor into the residence tests as normal, and there won't be any exception for them, even though on the face of it, it's the same circumstances. So we can only exempt up to 60 days, and that's kind of on a rolling basis. So if you had to stay in the UK for 2 periods, we're still looking at a total of 60 days for the tax year. We're not looking at 60 days for each individual occurrence. So it's something that we want to be keeping an eye out for with clients is if they've had to stay in the UK and work, perhaps they're working in lots of different countries. and they're required to work in the UK for longer than expected, we want to be keeping an eye out for those exceptional circumstances when we're applying statutory residence rules, because they may have stayed longer in the UK and become a UK tax resident as a result. The second section I wanted to look at is employment income. Typically, where UK employment duties are performed in the UK, those duties will be subject to UK income tax. The specific point that we're looking at here is for non-UK tax residents. So you will already need to have concluded on your statutory residence analysis and found that they are non-UK tax resident before we're looking at this. So they're non-UK tax resident for the tax year, but they might have employment income, and for a period of time they may have been in the UK and had to perform their employment duties. I mean, many of us are probably no stranger now to working remotely. So where they are non-UK tax resident, typically what we're able to do with employment income is that we're able to apportion it on a just and reasonable basis. So the portion that's taxed in the UK is just the portion of income where you were performing your employment duties within the UK. And when you are non-UK tax resident and say performing your employment duties in France, well, the UK has no rights to tax that income. So HMRC have advised that if you were stranded in the UK, let's say, and required to perform your employment duties, what we can do is remove that portion of your employment income from the UK tax net. So it will count for the period of time when you were expected to leave the UK and when you actually left the UK. In that period of time when you performed your employment duties in the UK, we can actually remove that, but it's subject to certain conditions, and those conditions are that same income needs to have been subject to tax in your home country. So it's not escaped tax completely. All it has done is it's been subject to tax elsewhere. If it hasn't been subject to tax overseas, then we're not going to get any relief in the UK. And HMRC is, they're wanting evidence on this. So realistically, we need to be providing a copy of probably the overseas tax return to show that the income's been taxed overseas, and also evidence that they were prevented from leaving the UK, so possibly a positive COVID test or something along those lines. I won't spend much longer on this point, but there's a small point to make with regards to non-domiciles. There is a particular rule that allows that non-domiciles, UK tax resident non-domiciles in the first 3 years that they're resident in the UK, can apply for something called overseas workday relief. So it's a similar kind of rule in that we can apportion on a just and reasonable basis the income that's taxed in the UK, and those non-domiciles can basically only be subject to tax in the UK on their UK, where they perform their employment duties in the UK, and any time spent working overseas can be kept outside of the UK tax net, provided that they do not remit that income to the UK. So it's very much the same as a remittance basis claim. If they perform their employment duties overseas, it's within the first 3 years of their UK tax residence, and they haven't brought that income into the UK, then overseas workday relief can apply. Obviously, some of these individuals may have been stranded in the UK and therefore performed more days in the UK than they expected to, bringing their UK tax liability higher. Well, HMRC have confirmed that there's not going to be any relief for that, unfortunately. And I believe the logic behind that is that there is a possibility that that income wouldn't be taxed at all as a result, because it may not be taxed in the home country. So they've basically said that there's no relief there. So if you do have that case, we're not going to get any relief for any UK employment duties. And the final point that I wanted to cover before we finish is individuals that have come to the UK specifically to work on certain COVID-19 related activities. So they only apply for the 1920 and 2021 tax years. And in order to apply, that individual needs to have been non-UK tax resident in 2019-20, but also tax resident in another country, probably their home country, by the domestic laws of that territory. And they've come to the UK for the purpose of one of the following two reasons, which is that they are a medical or healthcare professional and undertaking duties connected with the prevention, treatment, protection of coronavirus, or otherwise they were connected with the development of the production of medical products or equipment looking to undertake detection, treatment, prevention of coronavirus activities. So it's very much got to be to do with the pandemic itself. And what the rules do is they allow us to basically disregard a portion of time between the 1st of March and the 1st of June 2020, where that individual was engaged in a qualifying activity whilst in the UK. So it's basically, it's an allowance for people that were involved in the pandemic, and probably that the UK needed in order to, deal with what was going on. So those days and any ties to the UK that the individuals may have acquired in that period, and only that period, can be disregarded when we're applying the statutory residence tests. So it's a very specific provision and only applies to those types of individuals. And probably, as many of you may be aware, analysis on anything to do with the statutory residence test, and in particular this, needs to be provided on the tax return. We need to be giving HMRC the full facts of the situation and why those particular provisions apply. So yeah, for anybody that is advising clients on their residence, it's going to be important to keep an eye out, particularly in the 2021 tax year, for any periods where individuals were possibly required to stay in the UK for longer than necessary, as we may be able to apply the statutory residence tests in a slightly different way, and we may be able to give some kind of relief. Well, not relief, but there may be exceptional circumstances for the purposes of what's going on. And if you do have any queries, do feel free to call myself or Lewis on the number below, or drop us an email. And I'm sure we can give you some help. Our next seminar is in December, and is on succession planning and divorce. And we also have one in January on stamp duty, land tax and relevant reliefs and so on. So do feel free to come along if those are areas that you're interested in. And I think that brings us to the end. So, Lewis, are there any questions that we've had through during the webinar?
I think we have one question here. So someone wanted to check their understanding on double tax treaties. So they wanted to confirm, is the first step always to check the double tax treaty? And if it allows both countries to tax the income or gain, then double tax relief is available on the lower of UK and overseas tax paid.
Yeah, that's right. Yeah, the double tax treaty is an important part of your residence analysis, and as you say, the treaty may provide that one country has the taxing rights, or it may provide that both countries have the taxing rights. Where you have a UK tax resident individual and they've suffered tax in an overseas territory, typically you can get UK tax relief on the lower of the UK tax suffered on that income and the overseas tax suffered on that income. So oftentimes they may have suffered less tax in the UK, so there's a little bit more tax to pay in the UK on that same income as a result. So it very much it eliminates the kind of double tax aspect. You're not suffering any more than you need to on that same income. But yeah, the double tax treaty is something that we check with regards to every client when we're looking at residents and they've got some form of overseas income. It's a very important tool.
Can we fit one more question in before 10, Ryan?
Yeah, I think so. I mean, is there any more questions in the?
Yeah, just one more question. So, do you have any practical experience of HMRC applying its guidance on whether the 60 days is the absolute maximum it will accept? Example, if borders are closed for longer than that.
It's not something that we've dealt with directly so far, but the way that the rules are written is that 60 days is an absolute maximum. So it's kind of a. I understand your point, because yeah, realistically, an individual could have been stranded for longer in the UK, and that those circumstances would have been outside their control. I mean, the 60-day provision is written into the statutory residence tests themselves, so it's it predates the COVID-19 pandemic. So prior to that, even if there was, even if you were stranded in the UK because you had a serious injury, let's say, and you were in hospital and you were unable to leave, or if borders were closed for other reasons, let's say war or civil unrest, you would still have only received up to 60 days exceptional circumstances for the purposes of applying the rules. So I don't think there's going to be any additional leeway on that as a result of COVID, but it's not something that I've come across as yet. So, possibly there may be something to consider, but I would, based on our understanding of the rules and the way that they're written, we're only going to get up to 60 days. which is a little bit unfair perhaps, but unfortunately we've just got to apply the rules as they are. Is there any other questions, Lewis? Is it just those two?
Yeah, I think that's all the questions. Bang on 10.
Okay, yeah, I think that brings us right to the end of our webinar. So I hope you've enjoyed this. As I say, if you do have any questions, do feel free to get in touch with us.
Ryan, we have one more quick question. Is that okay?
Oh, okay, that's brilliant. Yeah, that's fine.
So someone's asked, is it mandatory to inform HMRC when someone leaves the UK for tax purposes?
In what? I mean, what do we mean by tax purposes? I mean, what we would typically advise is with regards to residence analysis, that is included within the tax return. So HMRC have full facts of why we've applied the rules as we've applied them. And certainly with some of these additional provisions that we've been through today, it's going to be important to kind of say what's gone on, why they were stranded in the UK and so on. I don't think I fully understand the question with regards to leaving the UK for tax purposes, what that means. But certainly we generally try to provide more information to HMRC because it kind of precludes them from taking any action at a later time, because we will have given them everything that they need to really understand an individual's tax position.
So, informing for stop discounting PAYE.
Okay, maybe we could have a chat about this. I mean, what we're actually going to do, right, is if we end the webinar there, we have got a breakout session. So if anybody wants to stick around and have a chat with myself or Lewis, maybe we can get to this in a bit more detail, so people can stick around. But we'll what we'll do is we'll end the webinar there, and then we'll enable people's microphones, and if they want to stick around and ask us some questions, we can maybe go through this in a bit more detail. Okay, so just a second. Have you still got control, Lewis?
I think so. Yeah, so.
Okay. Okay. All right. Just going to enable people's microphones for people that are stuck around. So if you do have any questions, we'll do our best to answer them, but it may be something that we might want to have a go away and have a look at. Do feel free to chime in, those of you that have decided to stick around. Does anybody have any questions?
Yeah, hi. I'm not sure if you can hear me.
Yeah, Jabed.
Yeah, hi. Hi, Ryan.
Hi.
Yeah, so yeah, I was wondering if you could help me with this issue I incurred recently. So I have a client where them to be eligible for split year K6 on the basis that they met the usual conditions, and they were a UK tax resident in the past, and they've come back to the UK. Just to give an example,
just remind me which one is K6.
So ceasing to work overseas.
Okay, right.
So the client came back on the 23rd of July to the UK, and it was just it was meant to be like a little break, I think, for a week or so. But then due to the COVID lockdowns, he was stuck in the UK, and he continued to work from the UK.
Yeah.
And because he couldn't go back, his work ended on the 31st of October. So some of the things I'm considering is whether, I suppose, the client would probably be eligible for the 60-day
exceptional circumstances.
What's confusing for me is the impact that this has on the split year treatment, whether the overseas period begins from the day he came back to the UK. Presumably he ceased working overseas when he came back to the UK, or is it going to be 31st of October when his actual employment ended?
Right. Yeah, I think it's one of those that but as with anything on residence, it's normally best to kind of have the rules in front of us so that we can kind of look at how this applies. I mean, the relevant date will typically be an earlier date. I mean, we're looking at him stopping working in the UK, stopping working overseas from a particular point, and that's the relevant date for him arriving in the UK. Is that what we're saying under case 6?
Yes, yeah, that's what I would assess that as, because it wasn't intentional. He wanted to, he didn't want to stay in the UK. I think he wanted to go back. He was going to return, but he had to sort of stay back earlier than he wanted to because of the lockdowns. But yeah, eventually he just ended the employment on 31st of October. But he was in the UK since 23rd of July and couldn't go back because of the lockdowns.
Yeah, see, I mean, realistically, we're probably going to only get up to 60 days exceptional circumstances. So it may be that even in light of the 60 days, we still are UK tax resident for that portion of the tax year. It's an interesting one because, yeah, I can appreciate that he would have stopped working overseas directly as a result of being stranded in the UK, which is it's probably something that we'd want to have a look at in a little bit closer detail, just to see if there is going to be any allowance there. But I mean, my gut feeling is that the fact that he's spent so long in the UK, that there might be little that we can do, and I don't know if there's going to be, if we're going to be able to have a larger, a better split year treatment in terms of a larger portion of the tax year is going to be overseas and a smaller portion is going to be UK because he spent such a long time in the UK. So it's a good question, Joe, and it's not something that I've personally come across as yet. But it sounds like something that we might be able to look at in a little bit more detail. Does it materially change the individual's tax position in terms of what's subject to tax in the UK?
Yeah, potentially, because the other issue we have is actually he received some fellowship income from the UK, and I'm looking into the tax treatment for that as well, because it's not unusual employment income. It's more of he's being paid. He's a postdoctoral researcher. He's being paid for a research project. If anything, that's the only taxable element. And if the split year is deferred, so if the UK part is deferred, then that would probably mean he would have. If that fellowship income is taxable, there'll be less of it that is taxable in the UK.
Is it from overseas?
Because he was claiming he was claiming the income was earned in the US as fellowship income, and he was claiming under Article 20A, he was claiming the exemption for not paying tax in the US. So he hasn't paid anything in the US, but then if he's a UK tax resident from 23rd of July and that income is taxable, then that still needs to be reported in the UK as the UK tax resident from then, and it's part of the worldwide income.
Yeah, I think we actually have a client that came on board recently.
Both of those really impact that.
Similar income. Yeah, certainly something that we could look into. But it's like the thing with residence is there's so many moving parts with it. It's hard to kind of give a off the top of your head opinion. And to be honest,
I can understand. Yeah,
we don't really want to be operating on opinion. We want to be operating on a proper analysis of the tax position. But yeah, it is an interesting case there, because obviously I think the main thing that we might want to be thinking about is the fact that he, lost his overseas employment as a result of being stranded in the UK. But yeah, certainly something that we might want to look into if you wanted us to. Jabad, what do you do, Jabad? Are you a financial advisor?
I work in accountancy practice.
Oh, accountancy.
I work as an accountant. We do have contacts with you. I think in the past, if we really struggle to complete the sort of like a tax return for a client, we would probably do consult with you. But yeah, I just wanted to use this opportunity to ask that question.
Yeah, no, it's interesting. I think there's going to be a lot of interesting cases for the 2021 tax year as a result of kind of the disruption that COVID-19 has caused. You know, not only with people being stranded in the UK, but perhaps being unable to return to the UK that might have affected their resident status. So yeah, it's an interesting area. Thanks for that, Trevor. Does anybody else have any questions while you've got us?
Yeah.
So, sorry, no, was there anything else, Gemma, that you wanted to ask?
No, that's all. Thank you very much, Ryan. And yeah, thanks for the webinar. No
problem. Brilliant. If anybody else has any questions, feel free to fire away whilst you've got us. No? No, okay, I think that's everything. Okay, well, thank you very much, guys, for sticking around. It's been brilliant. I hope you did find the webinar helpful. And as I say, if you have any questions on tax queries going forward, don't hesitate to get in touch with myself or Lewis. So I think we'll end the webinar there. Thank you very much, guys. Take care.